Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be analyzing Keurig Dr. Pepper stock, ticker KDP. This one came in by request in the comments of one of my other videos. If you have a request, put it down in the comments. I'll get the ticker up on the chalkboard behind me eventually, and I'll make a video. Usually, I go through the comments a couple times a week, so it might be a couple days before I get back to you. And when I do, I'll let you know when I get the ticker recorded so I don't miss it. Little housekeeping note, there will be a name change coming to the Cyclical Investors Club channel this week, so keep an eye out for that. I'll probably put out a video about it tomorrow or the next day. It's not going to be a major thing. The content's going to basically be the same, but the name will be slightly different, so keep an eye out for that. As always, this is not individual investing advice, just how I analyze stocks. Keurig Dr. Pepper. So these guys make soda, and then Keurig is the little coffee Keurig machines. They merged probably around 2018 or so. As you can see, the stock split and everything. Well, we can look at the basic earnings, and you can see it clearly. Yeah, so 2018, you can see when the adjusted earnings diverge from the basic earnings. So we don't have data now. Obviously, Dr. Pepper's been around a long time, but I don't have public data on maybe it's based on the Keurig, since Keurig's name's first when they merged, since when it went public and not Dr. Pepper. And it's possible Dr. Pepper was private too. I don't think so, but anyway, we don't have public earnings data from before the Great Recession, but we do know that it's basically a soda company. So pretty stable earnings. So on this one, oftentimes I will use historical earnings growth to kind of project forward what earnings growth might be. In this case, because we have the big M&A and a bunch of adjusted earnings that are way different than the basic earnings, I'm just going to look at the forward earnings expectations, which are 6% each year for the next 3 years. And then we've had 5% in 2022, 7% growth 2023, 7. So when I look at this, I think a 6% earnings growth rate is reasonable to assume. And let's see, what else do we need to do? So the way I'm going to do this one is I'm going to have a time until payback analysis. What it tries to determine is if you bought this whole business and its debt, how long would it take for the business's earnings to pay you back an equal amount that you paid for the business? So if you bought it for $100, how long would it take for them to earn $100 in earnings, assuming 6% earnings growth over time, for them to earn $100 earnings back? So pretty simple. I had told you the earnings growth, well, I'm going to use a 6%. You can see why. The other thing I'm going to do is I'm going to adjust the stock price by the difference in the market cap and the total enterprise value here to account for debt and other obligations and things that they might have. So if you're going to buy the whole company, you would pay $61 billion.58 instead of the $44 billion market cap that it has, right? So when I do my calculation, I just adjust the stock price up, and that will make the earnings yield go down. So like if you look on fast graphs, the earnings yield's 6.02%. That's the inverted PE ratio. So the earnings over the price. So it means the same thing as the PE ratio, but it's in a percentage, and it makes it easier for me to calculate the things that I want to calculate. So if I get my spreadsheet to load here, which I did, I scrolled way down too far. I kind of just use this as a worksheet. There's HCA I was working on the other day. There we go. Okay, Keurig. So you saw that the earnings yield in the fast graph was 6.02%. I'm using 4.49% because I'm taking into account the total enterprise value instead of the market cap. So the way to think about this is you buy the whole business for $100, you would earn $4.49 that first year on your $100 that you invested, or for every $100 you invested. And then that would grow at 6% each year. I pull the first year forward, and then this is based on $2.04 in earnings, which I'll go back to. That's what they're expected to earn this year. So I'm pulling this forward, this year's earnings. I'm pulling forward another 6% growth, earnings growth. So we should start out with a little bit more than $4.49 the first year on $100. So yeah, we're going to start off with $4.76 you would earn the first year in your business. And then I assume you can take that money and go do whatever you want with it. You're not paying out dividends or buying back stock or doing whatever, buying other companies. It's just whatever the company is now, you get that. And then you get to grow that at 6% a year. And how long would it take for you to collect $100? So the first year you get $4.76, next year $5.05, next year $5.35. And it would take about, if you didn't see it already, 14 years until you earn your money back, or an amount equal to your initial investment back. So then the question is that a good amount of time to wait to take, or is it bad, or in the middle? I would say this is in the middle. It's kind of on the expensive side. Historically, if it gets to a 15-year time until payback, that's usually when I would consider trimming or selling a stock like this. If it gets to 10 or below, that's usually when I would consider buying. So it's a little in between that. I would say it's a little on the expensive side, probably valued about the same as the S&P 500 on average right now. So when you have a situation like this, then you can kind of zoom in. It allows you to compare different businesses with each other, because you can see what the valuations are, and then you can look at your assumptions. You can say, okay, if you compare this to some fast growth business that's growing 20% or something, or even 15%, if it's like one of the mega cap businesses, I don't know, Microsoft or something. What odds are more likely that Microsoft can keep growing 15% a year for the next 12, 13, 14 years? Or is it more likely that Dr. Pepper can grow at 6% for the next 14 years? And you can ask yourself those questions based on the businesses and how they've done in the past, or how you think they can do in the future, how big they are right now already. And sometimes it might be good to pick the more conservative business that's similarly valued, like Dr. Pepper, because you're only assuming they grow at 6%, and a couple percent of that is probably inflation. So you assume maybe they can grow at double the rate of inflation and grow their earnings. And there's maybe not as much risk there that won't happen. Also, with a stock like this, relatively small surprises to the upside can dramatically change it. When I'm talking about earnings growth, can dramatically change the amount of money that you can make in this stock. So let's say that they grow earnings 12% for a couple of years. Well, the market's going to value that much more. Like that's already down to an 11. And usually the market's pretty short term on this stuff. We need to get up to a 15% earnings growth rate before it would be a buy for us. But what will happen is, if they had like 2 years in a row where maybe they have a new product, right? We don't know what it is, or a new gizmo from Keurig that becomes really popular, and they put together 2 years of 15% growth. Well, the market is probably going to value this company. Oh, it just switched to 15. The stock price just ticked up. You can see it changed from 14 to 15 years. So it is pretty expensive. This spreadsheet updates the prices in real time. If they improve that earnings growth on a slow growing business by quite a bit, for usually 1 year isn't always enough, but if they get 2 years, then the market will start to believe it and extrapolate it out a little bit more. That's when you can get like a double, in a stock like this, because expectations are actually that they're only going to grow at 6%. And whereas on the other end, if you take, I don't know what Microsoft's actually growing at. I want to say it's like 13% or something like that. But if Microsoft just slowed earnings down to 6% or 7% from 13, the opposite happens. So you get multiple compression, right? and the market starts to extrapolate that out more. And so there is a benefit sometimes to these slower growing businesses, as long as they're growing faster than inflation and they're growing fast enough to actually have real growth. There can be a benefit to owning the more value oriented businesses. Now, especially if you can buy them cheap. This isn't cheap, but if you could buy it cheap, then, which is probably 50% lower than where it trades now, I can give you a buy price actually. So one of the nice things is you can just test prices. Oh yeah, so let's try 17. So it looks like under $20. Yeah, about $19 a share. It would be a buy. Where are we at now? 30 something. Yeah, so like call it 40% lower from where it trades now. So if you were to buy it then, and then especially if you get that earnings growth bump at some point, that's when you can make like really good money over like 3-year time periods, 5-year time periods on businesses like this. And eventually it will level out again, at a kind of slow rate like it's at now. Paying, a 15-year time until payback now, your return's probably the optimistic scenario, is you make single-digit percentage gains a year, I would say, from here. So not a buy, probably potentially a trim, depending on what your portfolio looks like. And hopefully you found this useful. I have a free tier over on Patreon. Make sure to check that out. I also have weekly picks for all the people who say that I never buy anything. I have a pick every single week there. It's $25 a month. And I'll see everybody later.